Last year I posted a video explaining why I think that REITs are better investments than rental properties in most cases. In short, studies have shown that REITs are typically more rewarding investments because they enjoy significant economies of scale, better access to capital, they're able to develop their own properties to earn higher initial yields, they can earn additional profits by offering services to other investors, they also have the best talent working for them, that obviously helps, they have better relationships with tenants, contractors, lenders, brokers, and finally, they're able to take advantage of distortions in the capital markets to issue shares when they trade at a premium, to buy new properties at a positive spread, or buy back shares when they are trading at a discount, creating value for their shareholders. But despite being more rewarding, they're also safer investments because they are liquid, diversified, professionally managed, conservatively financed in most cases, and shareholders enjoy limited liability. And finally, REIT shareholders also enjoy other important benefits. First, you won't be distracted and can therefore fully focus on your career to advance faster and quickly get to that next pay hike. Secondly, you maintain full geographic freedom to take on new opportunities as they present themselves, or you also get to travel the world without any constraints. And then thirdly, you have no negative impact on your general lifestyle. You won't get calls from tenants in the middle of the night or on the weekend, disrupting whatever plans you had. To my surprise, that video gained a lot of attention. It's been my best performing video so far with over 70,000 views and over 100 comments. It seems to have struck a nerve with real estate investors who find it hard to accept that such a simple and low effort strategy as buying REITs could earn higher returns than all the hard work that they put into their rental properties. It pushed many of these investors to comment on my video, and it made me realize that many real estate investors really don't understand much about REITs. There are still very significant misconceptions about them, and as a result, many will think that they are bad investments just because they are ill-informed. I kept facing 5 recurring misconceptions, and in today's follow-up, I'm going to address them once and for all. Hey, this is Yossi. I run a small investment firm that specializes in REIT investing. In today's video, I'm going to discuss the 5 biggest misconceptions about REITs. But before I get to it, I want to remind you that our Black Friday sale is still live for a few days. So if you want to access to my full REIT portfolio, you can do so by joining us for a 2-week free trial. You won't get charged anything for the first 14 days. You can explore our research, see what I'm investing, what I think are the best top picks for 2025, completely risk-free for 14 days. If you then decide to stick with us beyond this period, then you'll also get an additional $100 discount as part of our Black Friday sale. Check out the first link in the description of this video. So the first misconception that I keep on seeing is that you cannot use leverage when investing in REITs. Real estate investors seem to think that you cannot use leverage when buying REITs, and therefore you cannot achieve the same returns as with rental properties, which typically enjoy 60 to 80% leverage. But this is just simply wrong. What these investors ignore is that REITs enjoy the exact same benefits of leverage. The key difference is that you don't need to take out a mortgage yourself, since the REITs will handle all of that for you. When you buy shares of a REIT, you're providing them the equity, or put differently, your investment is the equivalent of the down payment. The REIT then takes your equity and adds debts on top of it to leverage it and earn better returns. As such, your $50,000 investment in a REIT may well represent $100,000 or $150,000 worth of assets, depending on how much leverage the REIT is utilizing. It seems that a lot of real estate investors are confused by the fact that what's traded on the stock market is the equity value. It's the equivalent of your down payment. It's not your total asset value. And in the case of REITs, this leverage is actually even better because you won't need to sign on any of the mortgages yourself, and therefore your personal liability is protected. Moreover, REITs have access to a much bigger variety of different capital sources, including bank mortgages, bonds, convertibles, or even preferred equity, allowing them to better leverage your capital and improve your risk-adjusted returns. The REIT will also typically get better terms than you could because lenders prefer to lend money to a large, diversified, public, SEC-regulated company with countless analysts covering them rather than a small private landlord. So all of this to say that REIT investors enjoy the same benefits of leverage. What you see on the stock market is the equity value, not the total asset value, but nearly every REIT adds debt on top of your equity to leverage it, and therefore this is not a unique advantage to private real estate investments. The second misconception is that REITs are not tax efficient. This misconception stems from the fact that REIT dividend payments are typically classified as ordinary income, but the reality is that taxation is much more complex than that, and in my cases, I actually pay less taxes investing in REITs rather than rental properties. REITs are incredibly tax efficient because of several reasons. First of all, they pay 0 corporate taxes, giving you the benefits of limited liability at no cost. Secondly, REITs will typically return 30 to 50% of their cash flow to reinvest in growth, and since they pay no corporate taxes, this cash flow is completely tax deferred. You're not paying any taxes on it, it gets directly reinvested by the REIT, allowing you to compound faster. And some REITs like SBAC Communications, which is a major cell tower REIT, retain as much as 70% of their cash flow, so you're essentially only paying taxes on what they're distributing to you, in this case, just 30%. Then thirdly, a portion of the distribution is typically classified as return of capital, which is not taxed either. It simply reduces your cost basis, just like depreciation in the case of private real estate. Then fourth, the portion that gets taxed as ordinary income also gets a 20% deduction, lowering your effective tax rate. Fifth, REITs will typically invest in Class A properties in growth sectors like data centers, e-commerce warehouses, cell towers, and those properties come with lower starting yields but enjoy faster growth and appreciation, which is also tax deferred. Six, REITs have the scale to hire their own in-house legal team to fight off property tax hikes, reducing their impact on profitability. That's something that you simply couldn't do unless you own hundreds of millions or even billions worth of properties, because you need economies of scale to hire your own lawyers. Seventh, REIT also shield you from any type of property transfer taxes, which can be quite significant in some markets. You're simply buying an interest in an existing portfolio rather than buying an entire property, which could come with significant transaction costs, often accounting for up to 5 to 10% of the property value. And then finally, if all of that still isn't enough for you, you could simply put your REITs in a tax-deferred account and be done with it. So again, saying that REITs are not tax efficient simply because the dividend gets classified as ordinary income is nothing more than a misconception. In my case, I pay less taxes investing in REITs rather than rental properties. Hey, before I go into the third misconception, can you please do me a huge favor and click the like button and subscribe to the channel if you think this type of content is valuable. That will help me a lot to keep on growing. Thanks so much in advance. The third misconception is that the yields of REITs are too low. Real estate investors will often look at major REIT ETFs like the Vanguard Real Estate ETF, ticker symbol VNQ, and see that they only offer 4 to 5% dividend yields, and then compare that to the higher cash flow yields of their rental properties, concluding that REITs are poor investments. But there are many issues with these comparisons. First of all, dividend yield does not equal to cash flow yield. As we noted earlier, REITs will typically retain 30 to 50% of their cash flow to reinvest in growth, which is beneficial for REIT investors because it increases the tax efficiency. Therefore, if you're getting a 5% dividend yield and the payout ratio is 50%, the actual cash flow yield is actually closer to 10%. The REIT retains half of it and reinvests in growth, which will lead to higher cash flow per share and higher share price over time. So you need to consider the cash flow yield of a REIT and not just its dividend yield. Secondly, it's also important to consider that these REIT ETFs offer a low yield because they are mostly invested in mega cap REITs that use little debt and invest in growth sectors like data centers and e-commerce warehouses. These REITs will typically only have a 30% leverage, they own lower yielding properties that enjoy faster growth prospects, and so naturally the dividend yield of these REITs will be lower. So you're really just comparing apples to oranges here, and if you're looking for high yield, you can actually find that in the REIT sector, but you need to look beyond the major ETFs. There are plenty of individual REITs that are offering dividend yields in excess of 8%, and that's despite retaining significant cash flow to reinvest in growth. A good example of that will be EPR Properties, which we own in our core portfolio at High Yield Landlord. As I mentioned earlier, you can access my full portfolio by joining High Yield Landlord for a 2-week free trial. First link in the description of this video. The fourth misconception that I keep seeing is rental properties claiming that they can earn 20, 25, or even 30% annual total returns by investing in rental properties, and they will then say that REITs don't come close to that. But that's all talk in most cases. First of all, when they are talking about 20% plus returns, they are typically referring to a specific property that they've cherry-picked, and they are comparing that to the averages of the REIT sector, which includes good and bad REITs. So right off the bat, the comparison is meaningless because you're comparing an exceptional rental property investments to the average of the REIT sector. I could also point to an exceptional REIT and compare its returns to that of an average rental property investments to make REITs look better, but that wouldn't really help us in this debate of REITs versus rental properties. To give you an example, innovative industrial properties earned a 17x multiple in just 5 years to shareholders from 2017 to 2022. No rental property come close to that. This REIT managed to turn $100,000 in nearly $2 million in just 5 years. But obviously that's not representative of your average REIT, and therefore we need to stick to averages here if we want to have a good comparison. And studies here show clearly that REITs outperform private real estate by 2 to 4% per year on average. I'll put some charts on the screen comparing the returns of REITs versus rental properties. You'll see that REITs are a bit more rewarding, and private real estate investments typically generate about 8 to 10% annual total returns in most cases. Some of you may be able to earn higher returns than that, but most of you are likely just miscalculating your returns in two ways. Firstly, you fail to account for the value of your own time and labor. You will work countless hours to find the right deal, to negotiate it, to finance it, renovate it, market it, manage it, and so on. And you will assume that all of this labor is free, even as you could have used all this productive time to earn a wage or started another business. If you now assign a value to your labor, say $30 per hour, you would realize that a significant portion of your return is actually coming from your own labor and not from your passive property investment. The second mistake that a lot of investors will make is that they will refer to the returns of a typical good year in a bull market, but returns are very bumpy in real estate. You may earn a 20% average annual total returns for 3 years in a row, but then the fourth years come and you get hit with a heavy bill. Perhaps you have a leaking roof, you have some water damage, you need to fix up the property, and that causes you to lose 2 years of rental income in just a few days. Then there will also be some years when property values drop, and if you're 80% leverage, all it takes is a 10% correction and your equity value will be cut in half. So over a full cycle, your average annual total returns are a lot lower than in your typical good year, and that's especially true after you deduct the value of your own time and labor from your returns. Studies that account for these adjustments find that REITs are more rewarding, which really shouldn't be a surprise given that real estate is a low margin, low barriers to entry business in which economies of scale play a major advantage. And if you're still not convinced, consider that Warren Buffett became the richest investor on earth by compounding his capital at 20% annually. If rental property investors were able to casually earn 20, 25, 30% annual total returns, I think we will have a lot more real estate billionaires. And then the fifth misconception that I keep seeing from real estate investors is that REITs are just paper assets. Real estate investors here seem to imply that REITs are not backed by anything tangible, they are just paper and could disappear overnight and there's nothing you could do about it. But this of course makes little sense. I mean, everything is backed by paper in some form. Your real estate ownership is backed by a deed, which is paper. Your mortgage is paper, your property taxes are paper. If you don't take this paper seriously, you will quickly lose your property. You could put your property in an LLC, as many do. Then in that case, it's the LLC, paper again, which owns the property, and you simply own the paper. No different than a REIT investor who owns an interest in a corporation that holds the real estate. The reality is that the corporate structure, again, paper, is there to limit your liability risk. And moreover, seeking a listing for the corporation on a stock market also benefits you by allowing the REIT to raise capital more efficiently, accelerating its growth prospects, boosting its profitability, and reaching higher returns over time. But somehow real estate investors seem to think that if you cannot see or touch the property yourself, then it doesn't count. But you could actually do that with REITs if you want. Most REITs will provide a comprehensive list of their properties on their website, and you could go visit them in person yourself if that reassures you, or you could use Google Street View, which I regularly do when doing due diligence on various REITs. Finally, for those of you who seem to think that REITs are risky investments because they are paper assets, perhaps you should consider there's only been a handful of REIT bankruptcies over the past decade, but there are countless real estate investors filing for bankruptcy protection each and every year. REITs are typically multi-billion-dollar organizations that are SEC regulated. There are countless analysts closely monitoring each and every move from their management teams, including even short sellers looking to profit from any mistakes that they might make. Therefore, paper does not make REITs riskier. On the contrary, it makes them safer. They are public, regulated, transparent, they enjoy limited liability, unlike private real estate investments. I also used to suffer from these misconceptions back when I worked in private equity real estate, but as I learned more about REITs, I realized that I was simply ill-informed, and eventually I concluded that REITs offered better risk and hustle-adjusted returns in most cases, and this caused me to switch from private real estate to REIT investing. If you want to access my full REIT portfolio, you can do so by joining High Yield Landlord for a 2-week free trial. It's the first link in the description of this video. Finally, if you could please click the like button, that will help me a lot to keep on growing. Thanks so much in advance. See you at my next one. Bye-bye.